Good evening. As we approach the end of 2025, global currency markets are unusually calm, with a sense of stillness settling over the world's major financial centers. Major Asian currencies, like the Japanese yen, are barely moving, typical for this holiday season when activity slows to a crawl and volatility drops to some of its lowest levels of the year. With many top traders and investors on break, trading volumes are thin, meaning fewer people are buying and selling currencies. This seasonal slowdown is a familiar pattern, as financial professionals take time off to spend with family and reflect on the year gone by. This lack of activity keeps prices stable and dramatic swings rare. The usual hustle and bustle of the trading floor is replaced by a quiet hum, with only a handful of staff keeping watch over the markets. The quiet is global, from New York to Tokyo, and reflects a market in pause, not panic. It's a time when even the most active traders step back, and the world's financial pulse slows down. For most people, this means stable exchange rates and little impact on daily life. Travelers and businesses can plan with confidence, knowing that sudden currency shifts are unlikely during this period. The market is essentially taking a breather, waiting for the new year when trading will pick up and new trends will emerge. Investors are watching for signals, but for now, patience is the prevailing strategy. This lull isn't about uncertainty, it's a predictable, seasonal pause. Every year, the end of December brings a natural slowdown, as the world's financial community resets and prepares for what's next. The big questions about the economy remain, but for now, the markets are in hibernation, quietly waiting for the first signs of movement in the new year. Despite the holiday calm, a major trend is quietly unfolding, one that could shape the financial landscape for months to come. The US dollar, long seen as a pillar of global strength, is now showing signs of weakness. The dollar index has slipped to its lowest point in 3 months, a clear signal that investor sentiment is shifting. This drop reflects growing expectations that the era of aggressive US interest rate hikes may be over, at least for now. Many investors are betting that the Federal Reserve has finished raising rates, and some even anticipate rate cuts as early as 2026. This change in outlook is rippling through global markets. Lower US rates make the dollar less attractive to global investors, who are now searching for higher yields in other markets. As a result, capital is flowing out of the dollar and into other currencies, especially in Asia. This shift has pushed the dollar down and given Asian currencies a much-needed boost, helping them recover from months of pressure. For many Asian economies, a weaker dollar is more than just a headline. It means cheaper debt repayments, since much of their borrowing is denominated in dollars. And it also makes their exports more competitive on the world stage. Even with trading volumes thin during the holidays, this trend has provided a welcome sense of stability for Asian currencies as the year draws to a close. The narrative is shifting away from a strong dollar world, and this has big implications for global trade, investment flows, and economic growth. Markets everywhere are recalibrating their expectations. The dollar's direction will remain a key story in 2026, influencing everything from commodity prices to emerging market stability. For now, Asian currencies are enjoying a rare moment of support, with investors and policymakers alike watching closely to see if this trend will last. Beneath the surface of the holiday lull, an important shift is underway, one that could set the tone for the new year and beyond. As the calendar turns, all eyes remain on the dollar, with its next moves poised to shape the fortunes of economies around the world in the year ahead. Amid the quiet, Japan is in the spotlight. The yen, one of the world's most traded currencies, is under intense scrutiny as the Bank of Japan nears a possible policy shift. After years of ultra-low rates to fight deflation, Japan is now facing persistent inflation above its 2% target. Speculation is mounting that the Bank of Japan will finally raise rates, ending an era of easy money. Every economic report and official comment is being dissected for clues. The dollar-yen pair remains in a tight range, reflecting deep uncertainty. No one wants to make big bets until the Bank of Japan's intentions are clear. The yen's fate hinges on this looming decision. Today brought a key data point. Tokyo's latest inflation numbers. The Consumer Price Index for Tokyo is a leading indicator for Japan. December's report showed headline inflation easing slightly, hinting at cooling price pressures. Yet, inflation remains above the Bank of Japan's 2% target for another month. This mixed picture fuels debate. Some urge caution, others see proof that inflation is here to stay. The data gives ammunition to both sides, reinforcing uncertainty. Instead of clarity, the report keeps the market guessing about when the Bank of Japan will act. The guessing game continues, with the yen caught in the middle. Tokyo's inflation data offers clues but no clear answers. The Bank of Japan wants to see sustainable inflation, supported by wage growth and strong demand. With inflation above target for months, the first condition seems met. The slight easing in December may delay immediate action, but the direction is clear. Policy normalization is coming. Analysts expect a cautious, gradual approach, likely a small initial rate hike, then a pause. The central bank is wary of moving too fast after years of deflation. The market is left waiting for more evidence, especially from upcoming wage data. The timing of the first rate hike remains the market's biggest mystery. Beyond inflation, Japan's latest economic data paints a divided picture, revealing both challenges and opportunities for Asia's second-largest economy. The numbers show a country at a crossroads, with different sectors moving in opposite directions. Factories are struggling. Industrial production fell in November, signaling weak global demand for Japanese goods. Exporters are feeling the pinch as overseas orders slow, and some manufacturers have even scaled back operations or delayed investments, waiting for signs of recovery. Meanwhile, Japanese consumers are spending more, with retail sales rising despite higher prices. Shoppers are still filling malls and department stores, showing confidence in their personal finances and a willingness to pay more for goods and services. This resilience in household spending is a bright spot for the economy. Strong consumer demand is helping to offset some of the weakness in manufacturing, and it suggests that Japanese households remain optimistic about the future. The Bank of Japan faces a tough balancing act: support struggling exporters or respond to strong domestic demand and inflation. Policymakers must decide whether to keep interest rates low to help manufacturers or tighten policy to prevent the economy from overheating. Weak manufacturing argues for caution, while robust consumer spending and inflation suggest tightening policy. The central bank is caught between these conflicting signals, making its next steps especially difficult to predict. There's no easy answer, and the data highlights the complexity of Japan's situation. Economists are divided, with some warning of risks to growth, while others see potential for a sustained recovery if consumer strength continues. Policymakers must weigh the needs of both sectors carefully, knowing that any decision could tip the balance. The stakes are high, and every move is being closely watched by investors and businesses alike. The yen's direction will depend on which side of the economy proves stronger. Currency traders are alert to any sign of a shift in policy or momentum, as it could send ripples through global markets. For now, the mixed signals keep the Bank of Japan and the markets on edge. Investors are bracing for volatility, knowing that the next move could reshape Japan's economic outlook. The next move remains uncertain, and all eyes are on Japan as it navigates this delicate economic balancing act. The yen is stuck in a holding pattern pulled by opposing forces. Hopes for a Bank of Japan rate hike support the currency, but ultra-low rates and weak factory data hold it back. The interest rate gap with the US still makes the yen less attractive for investors. Every time the yen weakens, some traders buy in, betting on a future policy shift. But any rally is capped by concerns about Japan's fragile recovery. The result? The yen trades sideways, waiting for a decisive signal. This equilibrium will persist until a clear narrative emerges. For now, the yen remains the market's biggest puzzle. Europe's currency markets are also quiet, mirroring Asia's holiday lull. The euro and British pound dipped slightly against the dollar, reflecting thin trading and little news. Like in Asia, the main driver is the weaker US dollar, as expectations grow for Fed rate cuts next year. The European Central Bank and Bank of England face their own dilemmas. Inflation is falling, but growth is sluggish. Policymakers are cautious, balancing the need to defeat inflation with the risk of recession. This uncertainty keeps the euro and pound in check. For now, European currencies are following the broader dollar trend. The real action will come in the new year, when fresh data arrives. Until then, Europe's markets are in watchful waiting mode. The holiday calm is global. As 2025 ends, currency markets are in a state of quiet reflection. Thin trading has locked major currencies in tight ranges, giving investors time to focus on the big themes ahead. The weakening US dollar and the Bank of Japan's potential policy shift are front and center. Tokyo's inflation data highlights the central bank's dilemma. Inflation is sticky, but the economy is mixed. The yen's fate depends on upcoming wage negotiations and further signals from the Bank of Japan. Globally, traders are watching for new inflation and jobs data from the US and Europe. The holiday calm will soon give way to renewed activity in January. The questions simmering now will drive markets in the new year. For now, the world's currency traders are waiting and watching. The next chapter begins soon.